Prateek Agrawal, MD and CEO of Motilal Oswal AMC Johnson, right now on the show. Oodles and oodles of experience. Let's quiz him on all of that. Prateek, thank you for joining in. How do you view the current landscape, Prateek? We are no longer at 22,000, so valuations are not attractive, but a lot of stresses are out of the system. Does it make it a good playing field from a bull's perspective?
We have interacted before. Our understanding of what went wrong in Jan Feb was not valuations. It was more to do with currency and interest rate volatility that you saw, which caused levered players, both domestic and offshore, to square up positions in a very short period of time. And the message that you got from the market was just the opposite. People would sell what they own, people will buy what they may have shorted, and that causes the market to give you just the opposite feedback. Now that the interest rates and currency are more normal, not interest rates abroad are still high, but currencies have normalized. That's allowing people to, buy and keep what they like and sell what they don't like, the normal activity, and that I think is being represented by the market.
Interesting. Okay. Prateek, so, okay, the common sell side or the consensus sell side argument that is coming through right now is that the reasons may be whatever, but now that we've come to the levels that we have, we're probably trading anywhere between 22 to 24 times earnings for a market which is likely to grow maybe 10, 12%, 15% at best, but average about 10, 12% for the next couple of years. But it is also a market wherein foreign investors were heavily underweight and might now start turning overweight as well. What do you think the implication of all of this might be? Throw in, of course, the other factors that you believe are probably the more pertinent ones.
No, so, with whatever is going on globally, maybe the two largest economies will invest less into each other, which means if flows into global equity funds continue as before, chances of every other economy getting a tad more is higher. To the stated direction of policy making in the US is lower interest rates and weaker dollar. Weaker dollar has been happening. Interest rates yields need to come down. Now, if you were an emerging market player, you would be salivating at this, right? And on top of it, we have got oil $20 cheaper, which, while the global slowdown is yet to happen, more than compensates for any export loss on account of global slowdown fears. So on economy, as yet we are net positive. So
Okay.
that is what it is. But most importantly, India is a market which is driven by Indian investors, particularly the larger investors, retail and HNIs. So they lost some bit of confidence in Jan Feb because of the high volatility that was seen. Now, let's say second half of March onwards, we are definitely seeing a return of those investors. I thought the geopolitics that happened between us and the neighboring country, gave another opportunity to investors to come in. Now even that is behind. So unless you again encounter a large dollop of volatility on the currency, I think markets will do their bit. You spoke of earnings increase. Yes, this is a period when the old economy, what is there in the index, let's say, stuff that may have had a glorious past, but today most of that stuff is seen to be, baking in just about economic growth rate in numbers. We have to find newer spaces where the growth in earnings can be several orders higher. So our portfolios, we as growth investors just focus on those spaces.
Got it. Prateek, sorry, you seem to be suggesting that despite the valuation number looking higher optically right now, the markets are more likely to head higher as opposed to stabilize or correct.
Yeah, that is my personal view. I have said in December that valuations were not expensive, they're defendable. For the part that we were invested into, as yet, the part that we are invested into still leaves 15-20% from where they dropped. So we think there is still a lot more upside to be had in that part. That's not to say the same about the index that people follow, and more pertinently, the larger cap part of the market. So look at it this way, stuff that has gone from being small to mid is what we like. From mid to large is what we like. We don't like stuff which may have been in the same cohort for ages. Clearly it kind of means that they are losing the growth tailwinds.
First amongst equals, Prateek. Now give us a flavor. And I will at some point of time talk to you about defense individually. So let's park that for the time being in your answer. But what is it that has moved, let's say, from small to mid that would find that you like the more? I mean, I have some access to your AMC portfolios, so we can gather it, but would love to hear from your views.
No, so we are growth investors. So please
Of
take us
course.
in the context in which we are talking. Value investors will have a very different point of view. The start point is to, in the index, not look at spaces where growth in earnings would be, let's say 2% plus index and lower, because we believe that markets over time follow earnings growth corrected for valuations. And our job is to deliver alpha to the investors. So if market follow earning growth, it's 2% higher, fees is 2%, there won't be any alpha. So we look first. So this leads us to be away from commodities, most banks, most large IT, oil, refining, steel, cement, staples kind of stuff. All of this, you will find very little in our house. What we are more focused on are newer spaces. So we have been saying this is time for alpha. Alpha gets created when a new space emerges. It's new, so it's not there in the index or is less there in the index, is able to grow faster for several years. A great example of this is what software did in the 90s. Maybe private sector banks did from 2001 to 2020 and so on. So if you look at our portfolios, practically all portfolios will have some representation of capital markets, new tech, be it fintech or consumer tech, defense, renewables, EMS, and you get this drift, luxury consumption on China plus one, reasonable amount of exposure to manufacturing, and defense, of course. So that is what our makeup is. And in all of these spaces, you will find the earnings growth not only for last 2 quarters, and we believe this quarter will be multiple times index earning growth, but it shall continue for at least 2 more years. So longevity of growth and higher quantum of growth, we believe, are great combo for delivering alpha.
Got it. Prateek, a focus on two pockets really before we wrap up this conversation. One of them is defense, right? Massive, massive moves, and maybe rightly so. This morning, we were having a conversation with two companies, Zentech and Data Patterns. Both of them seem to suggest that don't expect massive fireworks in FY26, but this sets the stage for some long-term global inquiries and longer-term execution and therefore longer-term growth. Now, the street is buying defense as if there is no tomorrow. Can you speak about your view on this?
No, so like I said, we are positive on that space, hence all portfolios will reflect it. But as a part of the portfolio, in our portfolios, you should track weightages. In many of our portfolios, you will see us having trimmed positions when they become larger and build positions when they become smaller because of market movement, etc. So the whole point is to be not carried away by good happenings in one part of the market. Good happenings will happen to other part of the market also. So the way our portfolios are designed is to have all of the growth themes as the house fleshes out, represented in all portfolios. If I take a cricket match kind of an analogy, we don't want to let over go maiden. Some runs need to be scored. Yes, one manager may be more optimistic on one space and so on. So when that space works well, hopefully over a period of time, he gets bumped up in performance. So that is the design of portfolios in our house.
Got it. Prateek, the small other space that I wanted to speak a bit about with you is energy transition. Um, does the move or does the business continue uninterrupted? Because yes, the market correction gave a chance to people to buy in, but the management commentaries thus far don't seem to be different from what they were 6 months ago. The government targets probably continue as well. What's your sense about energy transition at the current valuations that they might be, whether it's wind energy, solar, equipment companies, what have you?
Uh, no, so we are again positive. Look at it this way, 2 years from now, a lot of it would be trading at commodity valuations. So I think the market accepts the view that they have 2 years, 2 great years going ahead for them, and after that, competition will come in, margins will get squeezed, etc., etc. So point is 2 years hence, they will be at near commodity valuations with significantly higher growth rate. So if we expect power demand in India to move up by, let's say, 5 odd percent, these spaces would still end up doing a CAGR of double digit for several years, 11, 12% for several years. So that's a number which is higher than all commodities. And with the ROCE, which is higher than all commodity players. So we think the combo that is presented, even if one assumes it gets commoditized after 2 years, is a good combo for making money from where we are, is our sense. And in the interim, these are managements who have built businesses from scratch to the current level. Well, they are not sitting idle. I mean, the fact that the business will undergo a lot of change, competition will come in after 2 years, is being told by them themselves. So we think they are taking actions to prolong the good period. Some may be looking at export markets. Some may be looking at doing a bundled service. So, buy land at some place so that they can do a full turnkey solution rather than just, supply a windmill or a panel kind of stuff. So I think all of them are definitely looking to elongate the good time while the times continue. Maybe some are looking at backward integration and so on. On wind, the increase in domestic content requirement, there is a paper floated for that, would hopefully reduce competition and again benefit the domestic players. So policy tailwinds are also there.
Most certainly, most certainly. Prateek, one final question. Anything that you are circumspect on, negative on?
The index, any space where growth is lower then the index we are very circumspect on. Lot of analyst focus goes there, but most of those spaces have had their best of times. They will grow at index or lower in terms of growth rates, and hence will result in or should result in lower than optimal results for investors.
Maybe. Or no? Like IT? I mean, or what? Just examples, one or two?
No, so take the best of banks. What will be the growth in earnings?
Okay.
Best of large IT, cement, oil and gas, metals. The earning growth wouldn't cross 10% for 1 year, 2 year, 3 years. So which is why I'm saying, just take the analogy of what happened in the past, what delivered great outcomes for investors, software in the 90s, private sector banks in early 2000 till 20, and then see what is available to you just now. It is not about size, it is about growth. People say size is safe. I say growth is safe. Else the index would have never changed its composition, right?
That's true. I mean, that's such a powerful line. Prateek, thanks for ending the interview with that. Really appreciate your time and look forward to seeing you
Thanks.
soon.
Thanks.